Welcome back to Everything Money. In this video, you will learn about Netflix stock. We will look at the financials and do a fundamental 8-pillar analysis on this company. We will use our stock analyzer tool in our software to show you what you should be paying for Netflix moving forward. And if you want to trade Netflix at a quicker pace, we will join Mo. He'll show you the trends and the charts. But first, why should you be watching this video? I bring your questions about Netflix to a couple guys who operate over $100 million in real estate, multiple businesses and stocks, and they will answer your questions and give you a mindset of investing about a company like Netflix. We'll show you the financials. We'll do it right now. Paul, what do you think about this? I know you use Netflix every day like me, baby.
Yeah, so share my screen real quick, Seth.
Go ahead.
As of Q2 2021, Netflix has roughly 209 million global paid memberships. Netflix subscribers in the US, look at this. So for everybody who loves Netflix as a growth company, this growth over the next 4 or 5 years is not astronomical. They're going from and think about it. What do I always say? Whenever we do our analysis, the bigger the company, the slower the growth, right? We're talking about gaining 14 million users out of 175 million in the next 4 or 5 years. That's 1 or 2% a year. Because think about it, Netflix is just so large. How do they get, this is US viewers. How many households are there in the US? 200 million? Wow. I don't know how many households there are in the U.S. 100 million, maybe? I don't know how many households in the U.S. right now. How many households in the U.S.?
They are taking
123 million. So this is bigger than the number of households, which means the average household has over one subscription, or that's viewers. So remember, what do they mean by viewers? On my account, I have 2 other people on my account who have logins for my house. Do they count that as a viewer? I don't know. So these are the things to understand as you go forward on Netflix. But I want everybody to remember that as fast as Netflix grew in the last 20 years, that ain't going to happen in the future. The next 20 years are not going to look the same.
That's true.
So look at that. The United States, it was 74 million paid memberships with a year-over-year growth rate of 10%. That's not a ton. Go ahead, Mo.
I totally agree. It's not possible to grow at that pace anymore. But what they are going to do coming into the future is they're starting to get into the gaming world, and the gaming is going to be included in your Netflix subscription. It's going to be just quote unquote for free in addition to everything you're getting. They're not doing price increases. So that's kind of one way they're trying to make it a little bit more sticky and attract more users.
In general, here's a stat. Here's a stat. Look at this stat. Share my screen. Some people would look at this and say this is terrible for Netflix. Share of average daily time spent in the US by platform. Netflix is decreasing that. Why?
Yes,
because there's more competition from other streamers, which was a very natural progression of the industry. You have a very high margin industry, right?
Yep.
How much does it actually cost Netflix for every extra user they get to pay them? Pennies, probably. So very high margin. A lot of other content out there. Look at Peacock. NBC's Peacock. The Office was on Netflix before. Now it ain't. Why? It's on Peacock. They're like, listen, this is a very popular show. Let's start our own streaming service. Disney Plus, same thing. Disney Plus is growing its average daily estimated users. So you have to sit there and remember that even a decreasing share, but of a pie that's growing and growing, is still good for the company. This is a prime example of how somebody could look at the stat and say Netflix is dying. These are how we can manipulate our numbers to make it look like a story isn't actually true.
And if you're drawn to the numbers, we're going to do an 8-pillar analysis on Netflix right now. We will show you our software. Paul, walk us through the process of investing in a stock like Netflix. Oh, there you go, Paul.
Where we go, this is our everythingmoney.com software. We go to the 8 pillars tool. We type in Netflix. So, guys, let's look at the stock over the last 10 years. Look at that. It was a $10 stock in 2011. Now it's $691. Okay. $300 billion company with $29 billion in revenue, 10 times revenue. So, guys, that immediately, this is more than software companies. But so the first pillar, we want the 5-year PE to be under 22.5. It's 140. Okay. So to me, this screams overpriced because we already saw the growth rate numbers are not going to be huge. And the way to pay a premium on PE is to have a high growth rate. That's not here. We want a 5-year return on invested capital to be greater than 9%. It's negative. Why? Because the average 5-year free cash flow is negative. Look at this average 5-year free cash flow, Seth. Mo,
Yikes.
look at this.
Minus.
Negative 1.24. Only last year did they get free cash flow of 151 million.
Yeah,
so far we have 2
surprising.
major X's. What was that, Mo?
That's quite surprising to me, actually.
Yeah. So pillar number 3, revenue growth over the last 5 years. I think it's a no-brainer here. 10.8 billion. We go to our income statement. On our software, 10.8 billion to 28.7 billion, 28.6 billion growth there. Pillar number 4, net income growth over the last 5 years. 440 million to 5 billion. That's huge.
That's
Now,
a big COVID jump.
10 times growth almost, 10 times growth. I don't think the next 10 years will be 10 times growth. Like, I don't see Netflix making 50 billion. It could happen, but $50 billion in profit next 10 years. So factor that in there when you're doing your stock analyzer. Pillar number 5. This is a silent killer, guys. We look at shares outstanding. We're still on the income statement, but now we scroll all the way to the bottom. We want to see shares decreasing. Why? Because companies that are decreasing their shares are giving you more ownership of the company by doing nothing. So let's say, for example, a company has 100 shares outstanding. You own 10 of it. That's 10% of the business. If they increase their shares to 120, you now own 8.33% because now you have 10 shares out of 120. If they decrease their shares from 100 to 80, you now own 12.5% of the business versus 10, owning the same 10 shares. So when they decrease their shares, they're giving you a larger and larger piece of the company. So at the bottom of the income statement, we have 432 million shares 5 years ago to 442. So it's increased, but not by as much as I would have thought.
Mm-hmm.
Pillar number 6. Now here's the problem we have, Seth. Pillar number 6 is debt. We want to look at how much debt they have relative to the free cash flow.
Yeah.
We take the 5-year free cash flow from the main page and multiply by 5. But unfortunately, it's negative. So this is automatically a moot point. We don't even look at it.
Mm-hmm.
So we go to the pillar 7 and 8 have to do with free cash flow. We want to see growing free cash flow. So free cash flow is cash from operations less your capital expenditures. Seth, please save my voice and tell me what are the 5 things we can do with free cash flow?
Okay, so free cash. They can, if they have it, Paul, which Netflix just got it recently, they can issue a dividend, they can buy back shares, they can make acquisitions, they can reinvest themselves, and they can pay down debt. Paul, I didn't think.
Oh my Lord!
I didn't think.
Good boy.
I didn't think you'd get the last one. I'm like, you always forget to pay down a debt.
It's a new watch. It's a new watch, Paul. It's giving me life. So Paul gifted me this watch, guys, for 100,000. So
100,000 subscribers. Yeah.
Go ahead, Paul.
So again, we're on the free cash flow statement of our amazing software. Now, what your Uncle Paul does for you, this free cash flow line is not supposed to be here. I added it to make the math easy for you. Oh. So 5 years ago, free cash flow was negative 2 billion. Last year was 150. Check mark there. Look at their free cash flow over the last 10 years. Always negative except for the last 2 years. So they're just now becoming free cash flow positive. Our final metric is to take the average 5-year free cash flow and multiply by 20, but it's for a market cap that we want. But it's negative, so it doesn't apply. So for those of you who have our software, you go to the 8 pillars tab. It does all this math for you. You don't have to sit there and do what I just did. It does it all for you. Guys, it's just insane out there. But does that mean it's not something to invest in? No. That's what we're now going to use the stock analyzer tool. So guys, remember, every investment is the present value of all future cash flow. So we use the stock analyzer tool to make assumptions about the future because we don't know what the future is going to hold. We have to make assumptions, and it'll tell us based on our desired return what we have to pay for the stock today. So, fellas, help me out here. First things first, years of analysis. Do any of us believe that Netflix will not be around in 10 years?
Mo, what do you think?
Oh, I think Netflix will be around and they'll be a good streamer for a long time. They have a good studio that they make good content.
So you're right. They are the leader, and I do like their shows they make. So, okay, Paul, you talked about competition, Paul. I mean, we forgot about things like Apple Plus, Discovery's making a new channel. So there will be more competition, but yes, it will be around. Keep going. Revenue growth.
Okay, 10 years. Let's do 3 years of assumptions. 3 assumption levels, low, middle, and high. Now, guys, big growth in the last 10 years. So give me some low, middle, and high assumptions on revenue growth.
Well, do you think slower, Mo? I mean, do you think 15, 17, 19, Paul?
Yeah, I was going to
way lower.
Say 14. What, Paul? Lower?
Guys, do the math.
My high end.
Well, so
1.14 to the 10th.
Paul, we don't do the math. That's why we have you.
No, my high end was going to be 16.
Okay. At 14% revenue growth for the next 10 years, that's $100 billion in revenue when they did $28 billion last year.
No, it's not going to happen. Okay, their revenue could probably drop to like high side 10.
So this
So to me,
579,
guys,
Paul?
so what are you saying, Tim? Seth?
579.
Mo, you think that's too low?
Yeah, it might be a little bit too low, but it's not way too low. I look at
Let's
that big
do this,
20%.
guys. Let's do 8, 10, 12. Let's do 8, 10, 12. Because even on the 12% for 10 years, that makes their revenue $87 billion. I don't think it's going to happen, but it could. They make some. I mean, this is by the way, guys. Everybody out there watching, this assumes no acquisition. So let's say Netflix decides to start buying some other streaming services. These revenue growth numbers are based purely on themselves. Keep in mind this way. This is right now, they're only expected to grow 10% in the next year on their revenue growth. 10% in the next year is what the estimations are. So you think 10 years from now, it's still going to be 10%? I don't think so.
I look at that 1 year 20% number, and that's what makes me go, oh boy. I mean, you've had a year where people have been staying home and really watching a lot of Netflix. I mean, there's really good content coming out, and we had Squid Games. It was $1 billion show, over $1 billion show. So people are using it, and the revenue growth is still declining in that way. So
look at it this way. Look at this article. Netflix global subscribers by country. The largest one is EMEA. I assume is European, maybe. United States and Canada is 10%. Latin America is 1%. Guys, I don't think they're going to be growing. This is this year. This is for the next year. I look at this going, I'll put in 12. I actually think it should be 6, 9, and 12. But I think 6% revenue growth for the next 10 years is probably pretty reasonable if the next year is supposed to be 10%. Why would it all of a sudden go up with all these streaming services coming out?
Mm-hmm.
Paul, will their profit margin go up if they start making their own shows, or will it cost more money to make these movies, of course?
Well, they already spent a lot of money, but they already spent a lot of money making shows. I think I read somewhere like they spend $17 billion a year on production.
Mm-hmm. I think
but
that
it's all
profit
about
margin
people there.
Yeah, I think the profit margin around the 9% area will probably stay consistent. I mean, they're spending a ton on shows. But remember, they're still a software business. A lot of their business is still software.
Yeah, so I put 8, 10, and 12% profit margin.
Okay.
Now, there will be compression in the margin due to more competition, I can assure you.
Mm-hmm.
Right? So free cash flow margin, this is the hard part because the free cash flow is very different from the net income. And that happens because of different ways of deducting and depreciating different assets they have. I would still, over long periods of time,
how long are they not going to make any money?
Yeah, I don't know, Seth. Because look at this. Their profit margin of the last 10 years, they showed a profit without having cash flow. So let's look at their cash flow statement. Well, capital expenditures are actually pretty low overall. Okay. So let's do this. Let's do 6, 8, and 10 on this one. Lower free cash flow than the earnings, but it should equate out over time. PE. All right, guys, everybody here looks at a 60 PE and says, oh, 30 is a discount. No, this company's not going to be growing as much. Give me some PE numbers.
Mo, what do you think? High side 15?
Probably. I was going to go 12, 14, 16.
Same with free cash flow. And desired return, guys, I always do 12.5% because you can invest in an ETF, market-based ETFs get 9 to 10%, 9 to 10%. So to do an individual stock and to put some margin of safety in there, we hit the analyze button.
Oh, boy.
Look at this, guys.
Ugly.
Mm-hmm.
It's ugly. Now, somebody out there is sitting there saying, Paul, you're just wrong. Your assumptions are terrible. Okay, let's do 12, 14, and 16%. And let's do 15 times earnings. Analyze. Still not worth it. Okay, let's do 20 times earnings.
Still
not worth it.
Change revenue growth and put it at 20, 25, 30. Just show that. Let's say it does it.
Wow.
Barely.
You just get in there. You just get
That's the point. That's the point, guys. That's how overpriced Netflix is, that they would be doing revenue growth in the next 10 years higher than they did in the last 10 years.
Paul, please,
30% revenue growth.
Stage.
Paul, please explain to our viewers the idea. This is not what we think the company is worth. This is what you need to pay to make a return. And Paul, I never thought about this. My stock buying process was buy and hope it goes up. And so I would buy Netflix over and then just hope. But this is really like you're thinking of what I need to make to own this asset, whether it's a house, whether it's a depreciating. This is your thought process. Double down on that.
So guys, every investment's the present value of all future cash flow. If I were to give you $1 a year for the rest of your life, what would you pay me for that today? Would you pay me $1,000? No. Why? Because you're probably going to live 50 more years. So you're going to pay $1,000 to get $50. Would you pay $1 for $50? Absolutely. That's all we're doing here. The stock analyzer tool allows you to sit there and estimate revenue, profit, margin, and a multiple, and decide, and then also what your desired return is. If you want to make 12.5%, look at this. If you want to make 5%, have these amazing assumptions, guess what? Buy the stock today, because you're only going to make 5% on it, assuming these major assumptions here. But going back to our original Netflix assumptions and assuming 5% return, it's still not worth it today. Assume a 0% return, still not worth it today. This means that if you buy the stock today and it does all of these things, in the long run, you will not make money on Netflix. Why? Because in the short run, every investment is a voting machine, and in the long run, every investment is a weighing machine. What drives the business value over long periods of time is the financials. Over short periods of time, it's your pimply neighbor kid who sits there and says Netflix is the best thing that ever happened. So just remember that as you're looking at any investment, it's the present value of all future cash flow. If I were to give you $1 a year for the rest of your life, what would you pay me? What would you pay me for that today? That's the question. That's it. That's all I'm doing here. If Netflix is going to pay me $1 billion a year for the rest of my life, if I owned it in full, what would I pay for that today? That's the question.
If you're looking to trade Netflix at a quicker pace, there is money to be made on these swings to go up and down. Mo, show us the charts and what people are doing in the Bid and Ask Nation.
So Netflix is a tough one to go at from a long-term perspective right now, just because you're in this very overbought area. You're hitting all-time highs. You're facing a ton of resistance up here. But rather, I would come over here and look at it from a swing trading perspective. If you just look at what's going on in the last month or so, there's very low volume. So that tells me that it can't get through this all-time high. It showed that today and made an all-time high today and fell right back down. And with what you're seeing over here on your daily stochastic, I could see this red line dropping below, and you have a beautiful short coming down. You can probably short this down to the 645 area. And if it gets through that, you're coming down to the 630. So this is looking like a really good stock that can pick up the short. Now, if you want to do a day trade on it, it's very good because it does have that daily volatility. It's expensive dollar-wise, and stock-wise. But look at this. It gets really good trends every day. This is on was this last Friday. Really nice trend engulfing candlesticks, over 80%. You come into yesterday, you could have had a little tiny short on it. On Tuesday. Yesterday, another great time to go long on this thing with some engulfing candlesticks. And today you're getting the short because you're under 20% moving straight down. So there's multiple ways that you can go ahead and trade Netflix. If you want to learn how to do this and trade with me, come and join me in the Bid and Ask Nation. You get my Employed Trader series, which is 6 stocks that I teach you about every single day that we can trade together. You get the Trading 101 series, which shows you exactly everything that I did right here, which will help you learn the rules that you need to be successful doing this. You get access to the Discord community of 900 people that all are interested in trading and can teach you. And you get my monthly seminars once a month, one Saturday a month. You get access to me. I take time to go through all Q&A with you. So the Bid and Ask Plations is a place to be. You can make money on these crazy stocks like this. It doesn't need to be just throwing money into it and hoping for the best.
Paul, tell them about the software. If this resonates with you folks about looking at the financials, you can have the software behind Paul, and he'll tell you right now.
So guys, this software we created because our users wanted to analyze their companies on their own, not wait for our videos to come out. So we made the software, spent hundreds of thousands creating it. You get all the tools here, including everything that's coming soon. You get the 8 pillars that you saw, and you get this all on a mobile phone. This software is all on the Apple and Android apps. You get the stock analyzer tool. You get access to Seth Mo and I. You get exclusive daily content. We post 2 or 3 videos a day for only our software subscribers. There's over 6,000 people there. And that's the best part. If you feel alone, like you can't talk to people about investing that are around you, we have 6,000 people around the world who all talk every single day about all these investment ideas. They don't all agree with each other, but they have the same fundamental belief. This is all available, guys. You get all of this plus 30 years of financial data and growing for only 90 cents per day, less than a cup of coffee. If you're able to increase your returns or decrease your losses by 1 or 2% a year, this will lead to hundreds of thousands and even millions of dollars in extra gains in your lifetime. 90 cents a day, everythingmoney.com or Patreon. Either way, signs up. You get it within minutes. The benefit of everythingmoney.com is you don't pay sales tax yet because we're not big enough. So sign up, 90 cents a day. It stays the same forever for you, but we raise the price every month on new subscribers.
Paul, final take on Netflix. Obviously, we're avoiding.
Avoid, like the plague.
That's our take. We will keep you updated. If a stock like this, folks, falls into the sweet spot of value investors' range, we might be interested in it. But if they're not growing,
that will happen. That will happen at some point in the future.
Yep, that's our take, folks. Join the community. Final thumbs up on the way out, and we'll see you next week. Thanks for watching.